Hello, friends. My name is Deepak, and I'm a tax code advisor. Today, I'm going to talk about some of the things that you should be paying attention to before the end of the year if you want to reduce your taxes for 2024. Now, oftentimes, people think that that's the only way or the only thing that you can do to reduce your taxes is in the taxable year, although that is not correct. There are some strategies that you can also implement the next year as well. So it's not the end of the world if you choose not to do any of these. But I think if you do implement these, you are going to substantially save on your taxes. Now, I might split this video into two videos depending upon how things go. And, I like to keep videos around 20 minutes. Anything over that, I like to split them in two videos. So, if that happens, maybe you'll see part one and part two. But this year, 2024 has been unique year, and I think 2025 going to be even more unique. Partially because of elections, depending upon how things go. Right now, we are seeing completely two different type of tax policies that can potentially be implemented in next year, and that's going to virtually impact everyone. But obviously, we cannot plan for that right now. We'll deal with that at the end of the year. What we can do is what are some of the policies in place today and how we can use some of those strategies to reduce our taxable income for 2024. So I'm going to be, especially be talking to business owners, people who have side hustle. There are almost, 45 million side hustlers in the United States. So I'm talking to a lot of people. But if you don't have a side hustle, then I would strongly encourage that you try to do something that can help you build wealth, that can help you reduce your taxes. So, having that said, let's get started. So, first thing I would recommend is let's review your business entities. I'm talking about your S Corps, your C Corps, your LLCs. If you have real estate, how you're holding those LLCs, and how are you setting up your payroll. Basic rule of thumb that I like to use, if your LLC made more than $40,000 in 2024, then we should perhaps upgrade you to an S corporation. And the reason behind that is when you are an LLC and you all the income is attributed to your LLC, then we have to pay self-employment tax on that entire amount of the entire income that you're getting from your business. But by upgrading you to an S corporation, we are able to divide your profit and your W-2 into two separate buckets. So we pay the self-employment taxes on the W-2 part of it, and we don't pay any self-employment taxes on the rest of the income. So if you made more than $40,000 in 2024, then we should be looking at that, taking care of that right now. Now, some of you guys might have LLC set up last year, and maybe you perhaps made an income last year, and maybe we need to go back 1 year and fix that. So in that case, we can always do something called retroactive S corporation. A little bit tricky, but can be done. But we got to make sure that we take care of that this year. So if you have income last year or this year, then we should take care of that. Now, one question you may ask me is, okay, Deepak, um, why do I need to take a salary from an S corp? Why divide into this profit sharing and W-2? Well, that's the law. S corp owners must pay themselves a reasonable salary to avoid IRS penalties. This is the key for minimizing self-employment taxes. Meaning, if you don't run a payroll, you have an S corp and you did not run a payroll, more than likely you're going to get in trouble. And that trouble is actually worse than IRS. I mean, these payroll taxes can be a pain, and states take it very seriously because they are collecting their share of revenue out of it. So please, if you have a corporation and you're not running a payroll, that's a big red flag. So we talk about that. The related conversation we can have is, well, how much salary should we take? Should we take 40,000, 30,000, 20,000, 60,000? Well, that's very subjective in nature. The key word here is reasonable. We need to take a look at your business, what kind of work you're doing, how much time you're spending, and then take a reasonable salary. So there's no really one hard number. We got to look at individual business and then figure that out. So that's like a discussion for one-on-one consultation. Some of you guys maybe you don't really have an LLC yet. Maybe you don't even have an S corporation, and you have some sort of startup or some sort of side hustle going on. So what I would recommend to you is selling even one product, even one service by the year end helps transition a startup into an active business. You need to have an active business if you want to unlock potential tax benefit. So many times I meet with people like, oh, I want to do business. I'm thinking about doing business. I'm going to do this business. This is when I'm going to do this business. But they're not doing business. Why? Because they're not selling any product. They're not selling any service. So please focus on generating revenue before December 31st, even if it is a small sale. That is so much better than having no sale. I like to see some income on a tax return, and if you cannot have an income, at least break even. A $0 tax return looks so much better than a negative tax return. So please pay attention and try to generate some revenue before the year end. If you're a business owner, whether you have an S Corp, whether you have a C Corp, or you have even an LLC, one of the key strategies that can help you is having a board meeting. From a tax point of view, it can help you, and from legal point of view, it can help you. It basically brings little bit more protection to your company. That means your business is set up with an oversight. There are people out there responsible for making sure that you're operating business in the manner it should. So holding a board meeting with your friends, with your family members, you know, your trusted advisors, they allow you to make different kind of tax reductions. For example, maybe you travel to go meet with them. Maybe you're you're going to have that board meeting in Hawaii or in Europe somewhere or in Asia somewhere, and you take your whole family and you go, to Disneyland in Paris, and that's where you're going to do your meetings. Not in Disneyland, but you get the point, like somewhere in Europe. When you're traveling, you can write off your travel, you can write off your meals, you can write off your meeting costs. All kind of expenses all of a sudden become tax deductible. At the same time, every year I will meet with people who have a real estate set up, let's just say in Texas, and they're taking a board meeting in Hawaii or they're taking a board meeting in Europe, and they want to write off all the expenses relating to that LLC. So one thing I do want to advise you is be careful with that. It needs to make sense. If you just have one small property making $5,000, $10,000 a year, and you're spending $20,000 on a travel for having a board meeting, that is just not a reasonable expense. It's not illegal. Technically, you can have a board meeting anywhere you choose to, but it has to be reasonable. You have to see, does it make sense for a business? So if you don't make those kind of decisions, then that will look really bad. So my recommendation is always make sure that whatever expenses you're deducting, they're reasonable in nature. Document all of your business discussions that you're having. Create a meeting minutes and make sure you're discussing key business. Some of the things that you should be improving, some of the problems you're having in your business. Make an agenda, have a timeline, who was present, what did you guys discuss, all that kind of good stuff. If you need help with setting up a board, if you need help documenting the board, make sure it's part of your operating agreement, and you want to get some help on how do you run proper board meetings, you can reach out to us and I'll be happy to help you with that. If you want to really make it even more professional and really seek business advice, then I can always be your board member and I can provide advice on how you can grow your business, how can you improve your finances. So I can definitely help you out with that. Next thing you want to pay attention to is your health savings account. Contribution to an HSA are tax deductible. So that's a beauty right there. If you put $5,000 in your HSA account, it's tax deductible. But wait a minute, let me back up for a second. Many of the small business owners might not even have an HSA account. All you need for HSA account is a high deductible plan, insurance plan. So if you have a high deductible insurance plan, you are able to open up an HSA account and you put money in it and it becomes tax deductible for you. If you withdraw the funds for your medical expenses, then that withdrawal is completely tax free. So it reduces your taxable income today and it gives you benefit in future. So for example, if you have a food truck, if you have a small business, if you have you know anything else that is producing active income, then having an HSA plan is a must for you. It saves you money today, it saves you money when you withdraw it, and it grows tax deferred. And if you don't use it for HSA, then you can always convert it into an IRA later on. So it's like a win 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 situation. For 2024, you can contribute $3,850 for individuals and $7,750 for families. So you should be doing that. If your kids have a W-2 income from your business, then your kids, I'm assuming they're independent, then they should have their own HSA account as well. So that strategy alone can help you as well as your kids. So be careful with that. Next thing I want to remind people is about FSA accounts. So these are flexible spending accounts. FSAs are similar to HSAs, but they're not the same. In matter of fact, they have quite a big differences. FSAs allows you to put pre-tax dollars for healthcare expenses, but they are use it or lose it, meaning unused funds are forfeited. You cannot get that back. So if you have any funds in FSA account right now, you should be thinking about how are you going to use it. Maybe you look at chiropractic services or dental services or eye services. You need to figure out where can you spend the money, because if you don't, then you're going to lose it all by the end of the year. So pay attention to that. If you have some LLCs that are just sitting around, or some other business structure sitting around and you're not doing anything with it, or maybe you met with an advisor who helped you set up something in Wyoming or Nevada and you live in a different state, all that kind of crap happens. And if these LLCs are just sitting not doing anything, you need to really think about dissolving those entities. If you need help, we can definitely help you out. You can try to do it yourself, but extremely important because of multiple reasons. Number one, LLCs cost you money. Number two, you also need to file tax returns. Number three, there are some compliance reports that you must sign. So it's just too much cost. So if you get rid of anything unused, that just simplifies your life. And I'm all for simplifying life. There's no reason for you to be carrying on that unnecessary headache. And related to that is also sometimes I see people do have business structure set up, but they're not set up in the most optimal manner possible. Sometimes that's actually costing them more than it should be. So we should be also looking at that. And then we should also be looking at these business structure from an asset protection point of view. Are you set up in a way that your assets will be protected? Most often people come to me and they say, well, I have an LLC, so my assets are protected, or I have a C corp, I have an S corp, or I'm Inc. They use this terminology, thinking that these terminology will help them from a lawsuit. That is not the case. You essentially need to set up a business that operates like a separate entity, and that requires certain things that got to happen. For example, you got to have a proper operating agreement that defines exactly how this business should operate. If you're operating without an operating agreement and something goes wrong, how are you going to be able to prove that this was a separate entity than you personally? You got to use separate bank account. You got to use proper structure. Your business, is that a member manage, is it or a manager manage? There's just so many nuances in setting up these structures, so we should be really taking a look at that. If you have kids, maybe they're under 18, maybe they're over 18, we need to start thinking about involving them in your business. Sometimes I see people, they just want to pay their kids but not involve them in business. That is a very, very risky idea. Sooner or later, you will get in trouble for that. So don't do that. There's a proper way of involving the kids. There's a proper way of paying the kids, and there's a proper way to build wealth for your kids. So you cannot just randomly do it. I mean, doing this one strategy alone can be worth millions of dollars if executed properly. But if you execute them in a wrong way, then not just that it will cost you, but you can also be at the audit risk, and you can it can cost you a lot of money for you as well as for your kids. The basic idea is paying your children who are under the age of 18 allows you to shift income to a lower tax bracket. And that obviously is going to save you thousands of dollars. But remember, federal tax brackets are different than the state tax bracket. So we need to pay attention to both of them. Wages that you pay to your kids are deductible to you. And because your kids are in a lower tax bracket, more than likely they would not pay any taxes at all, depending upon which state you are in and what kind of income that is. So pay your kids for a proper work that they're doing in your business before the year end, and make sure to document the task they did, and make sure you transfer the payments to their bank account. So if you're going to be using this strategy, at the bare minimum, at least set up a custodial account for your kids and transfer the money into that account. You cannot just come and write on your tax return that I paid my kids. That doesn't work that way. If you're a small business owner, then you should also consider setting up a solo 401k. Now, solo 401k can get a little bit tricky depending upon if you have employees or you don't have employees. But for the time being, I will assume you have no employees. If you do have employees, we'll have a separate conversation and we'll talk about that. A solo 401k allows you to defer up to 22,500, $30,000 if over 50 as an employee. And as an employer, you can contribute an additional 25% of your salary. So imagine you put the money as an individual, but then you also put the money as a business owner. And then you can take that money and you can convert it so that way you can access it as completely tax free in future. So very interesting strategy. Sometimes I'll meet with business owners who have, let's say, maybe not enough income to pay for their expenses, but they have other assets that they can easily take the income out from. So sometimes you can decide that, hey, I'm going to take a big, sum of money from my current income and put it all into 401k, and I will survive on income from my other assets. This strategy can also help you build tax-free wealth in a very efficient manner. So set up a solo 401k if you own a business with no employees and contribute by December 31st. So that's the key here. So we are approaching about 20 minutes, so I'll stop it here, but I have so many other strategies that I want to talk to you about. So I'm going to do that in part two and maybe even part three, depending upon how things go. But once again, my name is Deepak and I'm a tax code advisor. If you have a small business and you want to learn how you can reduce your taxes, perhaps you're looking for some strategies that can help you build wealth in a tax efficient manner, somebody who can give you strategies around not just to help your business, but help you personally, help your family, help you build a proper estate using the tax efficient manners, then I'm your guy. So you can reach out to me. My first introductory phone calls are absolutely free. I don't charge you anything. If you like what I have to offer you, we can always set up a comprehensive consult where I can look over various different manners of your finances, including your estate, asset protection, business taxes, personal taxes, retirement accounts, and we can see where are the opportunities, how you can leverage everything that is available to us right now. But the key thing is action. If you don't take any action, nothing happens. So please just go to taxcodeadvisors.com and set up an appointment and we'll go from there. And I will have many more strategies in part two or part three for 2024. So I will put those links once I publish them.